So we're going to do a training on mortgage protection. Mortgage protection is a form, a type of lead that most of us work, and in my opinion is the one vehicle as of today, February 2025, that would allow you the highest upside in what I call transactional sales within the life insurance industry, meaning you get a lead, you could probably sell them a simplified issue product 9 out of 10 times, where you're truly protecting the client, giving them what they need, but at the same time, you're also having a quick turnaround and getting paid in a timely manner for you to be able to reinvest into your business. Now, what is mortgage protection? Mortgage protection is just a form of marketing life insurance. The end goal is for clients to protect their mortgage. The biggest mistake I see agents make is that they think it's very simple and straightforward. For example, a client has a $300,000 mortgage. You're going to sell them a $300,000 policy. And even though that does occur, those are layups. Where you really make your money in mortgage protection is learning how to sell mortgage protection to seniors or folks that don't qualify for a policy in the amount of the mortgage balance. So that's where I want to place today's focus on, is how do we sell to seniors? How do we position this? The sale really starts with how intentional you are with everything that you say from the moment you get on the call with a client. So you want to start kind of setting up the stage so when you come in and you position a solution for the client, that they're not caught off guard. What do I mean by that? So when you come in and you're telling the client, hey, what the purpose of the mortgage protection program is, you want to start saying things as making sure that when you pass away, your family can keep the home. So if you notice, I didn't say making sure that you can pay off your home, and making sure your family can keep the home. Because in a lot of occasions, and we'll get to that, seniors are not going to qualify for the full amount of the mortgage. Quick note, things that you need to be familiar with is real estate lingo. So get familiar with terms, such as escrow, interest rate, insurance, mortgage terms, refinancing, reverse mortgages. Just, if you're not too sure, just go on ChatGPT or Google them and understand what they mean, because you do want to come off as an expert. And if you're able to talk this lingo with clients, remember all these clients went through the process of purchasing a home. In a lot of cases, they either just refinance or just purchase the home, so they still have those terminologies fresh in their mind. So what you want to do is come off as an expert and an advisor, and obviously that's how you build confidence and how you build rapport. Now, let's get into the meat and potatoes of it. So how do you position this for clients? What I like to do, and it's been very effective, I wrote over $1 million of life insurance premium with mortgage protection in my career, is you want to kind of walk them through and set the stage of what's going to happen when they pass away. So like any other typical life insurance sale, who's going to stay in this house when you pass away? If they're married, it's typically a spouse. If they're not married, it's typically one of their children. Remember, these are older folks, so their children half the time don't even really live there. But regardless, you want to identify who the beneficiary is going to be. And then you want to tie it back to what is it going to look like when you pass away. So what would I say once I figure out who the beneficiary is? Say something on the lines of, hey, Bob, do you know what happens to the house when you pass away? How does it work? Whether they said yes or no, I'd go into how probate works. So probate is basically the legal process for your loved ones to be able to take over your estate, in this case, this property. And what happens, Bob, is that when you pass away, the $1,800 mortgage payment that you're making every month, the bank is actually hoping that your family cannot pay that, because you have equity in this home. And for them, it's a very valuable asset to be able to take over this property. Imagine you've been paying it for X amount of years, and now if your family cannot make the payment, they get to take the house back. They just made a big ass return on their money. Remember, the banking system is rich because they're meant to be able to come up and take your money. Now we'll just simplify it that way. So what we're going to do today is we're going to put together a plan or a program where we can assure that your daughter Mary has enough to make the payments on the house, so she doesn't have to run from your funeral to the real estate office to try to sell the house for 50 cents on the dollar to make sure she doesn't lose it and salvages it. Does that make sense? As I've talked in other trainings, you got to get the client in the habit of saying yes multiple times throughout an interaction. Now, pieces of information that you have already at this point that you gathered in the beginning of the interaction, which I didn't cover, is you found out how long they had the home for. You're finding out how much they owe on the mortgage. You're finding out how much the property's worth, give or take. If you don't know how to figure that out, go on Zillow and it'll give you a Zillow estimate of what the property is probably worth on the market. And then you also want to figure out, like, what does their current income look like, who's paying for the property, and obviously who's going to pay for it afterwards. So you're presenting that. How are you going to actually present the options? So let's just say that Bob doesn't qualify for the $300,000 policy to cover the mortgage. And just for a simple example, his mortgage is $1,000 a month, all in after insurance and taxes. So what we're going to do is we're going to get a traditional final expense policy, and we're going to give options to Bob. I typically would price this out to have something in my first option somewhere $80 to $100, mid option somewhere probably in the mid to high 100s, and then a really high option probably $300 and above. And I will position it with monthly payments for their property. So let's just do basic math. Let's say we do 12,000, 24,000, and 36,000, just for the sake of the example. I would present three options, and the way that I would tell Bob is, listen, Bob, we got three options for you. We can get your daughter Mary 12, 24, 36 month worth of payments to cover the mortgage and make sure that she can either get the house, not run from the funeral home to the real estate office, and then she can have time to decide what she wants to do with the house, whether she wants to refinance, take it over, sell it, whatever the case may be. And the way that works, Bob, is for you to have 12 months worth of payments left behind to Mary, it would cost you $84 a month. If you want to keep her in the house for 24 months, that's going to be $185 a month. And then we're going to go with the most premium option of 36 months, and it's going to run you for $384 a month. Now remember, you were very intentional in the beginning when you talked about keeping Mary, making sure she doesn't lose the house, making sure she's able to keep the home. You want to talk about, saving the equity. A really good line that I've used in the past that helps me tremendously, helped me really well close the sale is, Bob, you've been able to build $250,000 of equity in this home. That is the biggest insurance policy you have for your daughter. You want to make sure that your daughter does not lose the $250,000 asset that you're leaving behind because she's not able to make those payments. And that's how you can overcome some of the objections of like, oh, I thought I was going to get $300,000, or $12,000 of insurance is not enough. No, we're not really protecting the house, we're protecting the equity in the home. And just for the record, I call this the equity protection program. Now, typically they're going to choose one of those three options, and you'll be able to protect the home. Now, big advice is what you want to do is, once you have, especially if they're leaving it for a daughter, which we see a lot, is you want to get the daughter's information, and you actually want to reach out afterwards. You could automate this through your CRM, or you could just send a manual text depending on how much volume we're selling, where you're asking where you're letting the daughter know that that's put a plan in place to protect the mortgage in the event that he passes away, obviously to reach out to you if something happens. But what that does is it's an easy way, because typically the kids of a 60, 70-year-old are already homeowners themselves, and believe it or not, I got the most referrals by reaching out to the beneficiary in a mortgage protection policy specifically, because they'll typically own a home as well and have nothing in place. Now, just to recap, you got to be intentional from the beginning. So you've got to use words like, let's make sure that we set you up so your family can keep the house or stay in the house. You're not using the lingo of like, we want to pay off your mortgage when you pass away, because you're setting yourself up for failure. You're going to present the options in the form of, we can make sure that we get them this amount of payments, whether that's 12, 24, 36 months, and you're going to customize this given the budget for the client. And lastly, the winning line, the golden line that you're going to use is, hey Bob, the equity in this home is the biggest insurance policy, is the biggest asset that you can leave behind. Let's make sure that your daughter, your significant other, your spouse, your grandchildren, whatever the case may be, let's make sure that they don't lose this property simply because we didn't have something in place to make sure they can make those payments. Let's not let the banks get any richer, and let's protect the asset that you work so hard to keep and to build. I hope that helped, guys. If you like what you heard, please leave the comments below. I'd love to hear your thoughts, and I'll see you in the next training.